Oh, hello, 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 hello. This is Elgin Walker from the E-Hustle, Living the E-Hustle broadcast. And we're doing our series right now in regarding purchasing real estate. Particularly, the beginning of this series is emphasized on purchasing for the first time. This particular topic, we're going to discuss about what part does credit play, your credit reports, in getting a home loan. We're only going to touch on a few things. We're going to keep it pretty simple. We are going to have a credit repair expert come on our broadcast here in the next couple of weeks that can give you some more specifics. But let's talk about credit in general. I think there are some real misconceptions, though, about where your credit needs to be as far as purchasing a home. You'll hear reports and you'll hear media stuff, and they'll say things like, right now that there's a credit crunch and your credit has to be excellent. And generally, excellent, you're talking about as close to 800 FICO scores as they can be. Now, needless to say, everybody wants that, and there are a few people that do have that, but that does not have to be the mainstay or main reason why you're able to purchase a home or not purchase a home. A lot of it depends upon the program, that you're going into. Now, needless to say, the better your credit is, the better opportunities you have in regarding the types of financing and interest rates that you will be able to finance for your home purchases. But let's start with this. Number one is, we talked about getting yourself pre-approved. With your credit reports, do you even know what's on your report? Do you realize that there are actually 3 reporting agencies that are used when you are purchasing a home? So you've got your Experian, you've got your Union, and wow, just left my mind. It'll come back to me again. Experian, TransUnion, and Equifax. And they take the mid score for that. So they'll take all 3 of your scores, and the mid score is the one that is used to determine your credit worthiness. So let's just suppose, though, that your credit maybe not be as good as it needs to be or that you want it to be. Maybe you have some outstanding debt that you want to pay down. Maybe you have some collections. You might have some things that are on there. What I suggest before you just start paying them off is that you should consult with that mortgage person first to look at what debt should be paid off, or at least paid off first. Obviously, the ultimate goal for anybody is to not have any debt. If you had no credit card debt, no car payments, no anything, well, of course, that's the best it can possibly be. But let's face it, you got into some sort of debt to begin with. Does that mean that you should miss out on home ownership while you're in the process of doing that? Now, that's a personal choice, but to me personally, I don't think that you should. I think that you should get yourself under control, make sure that your debt is not so high that you can't make the mortgage payment. But as we talked about in a previous broadcast, you're going to live somewhere. And you're either going to live somewhere and you're going to pay rent, or you're going to pay mortgage. You're going to pay yourself, or you're going to pay someone else. You're going to build your family legacy, or you're going to build the legacy of someone else. Not to mention, in a market the way we are in right now, still in the areas I service, you're looking at appreciation in your home that you're not going to get in other investment avenues. Plus, have something tangible. So that being said, you want to, in my opinion, you want to take a look at what your debt is, what your credit score looks like, and then speak with that mortgage professional on what debt needs to be paid off, what needs to be paid down. Like, for instance, most of you probably know, and if you don't, that your debt counts against you indifferently if you have less than 35% of debt versus what what they'll allow you to borrow against. So meaning, if you've got a $10,000 credit card and you owe less than $3,500 on it, your credit scores and your credit are not hit as hard as they would be if you owe $9,000 on that $10,000 credit card. You understand what I'm saying? I'm not saying you should have $3,500 in debt, but I am saying that as far as qualifying and you getting into a home, this is something to know. Your car payments. Car payments. And again, check with your mortgage professional on this because it is a moving target. But I know in the past, if you owe less than 12 months on your car payment, that doesn't count against you the same as if you just took out a car payment and you've got another 5 or 6 years to pay for it. Following me? So there are different ways that credit is used. There's different ways that it's perceived. You want to make sure that you are paying down the right stuff, that you are putting yourself in the best position to be able to get a home loan and get yourself into the home ownership game. Believe it or not, in most cases, they have FHA loans out there. FHA stands for Federal Housing Administration. It's a government loan, and it's for owner-occupied. 3.5% down in most cases. They have a very competitive 30-year fixed interest rate. It's whatever the prevailing rate is in other loans. They allow you a little bit higher loan to debt ratio, which is something you can get more specifics about with the mortgage person. But in most cases, most FHA loans, they'll allow you to have a 640 FICO score. 640, and you're pretty much in there. Now, I do know of some people that have gotten FHA loans with like a 620 or a 625. I have heard it advertised as low as 580 and all of that. I don't know if that's true or not. I have never experienced one of my clients getting an FHA loan with their FICO scores, that low for home purchasing. But even if you are in that category, there are specific things that you can do that can help you get your FICO score up to where it needs to be quicker. So credit, though, is a big part of you're not paying cash or you're not putting a lot of money down. Even if you're putting a good portion of money down, your credit is going to make a difference in your financing, particularly in regards to what your monthly payment will be with your interest rates. But your credit does not have to be the only reason you're able to purchase a home, but it's the most conventional way, and it's the way that you should want to go if at all possible, unless of course you have the ability to pay cash. And if you have the ability to pay cash, well, then we're talking a whole nother ball game. But for those of us that need to finance, myself included, these are things that you want. You want to have your debt down. You want to have your credit in the best position you can possibly have it in, but you also want to have that you can be paying off the right credit and make sure that you can stay within your budget and make your monthly payments. Okay? Hopefully this has helped. Hopefully this put you in the right direction. If you need a mortgage professional, a credit repair person that you want to talk to, we can recommend people for you. And as we always close, remember, no matter what you're going through in life, it's just a temporary condition because things really do change. And no matter what, it truly is. It's a great life. So God bless you. I hope that everything is working out for you and your life and everything else. And hey, the Elgin and Farrar Walker team, we're here to support you in any and all your real estate needs. Have a blessed day, man.